Okay, so let's solve some more problems. So this is the second video. In my earlier video, I had solved some problems, and now we'll continue. So this is managerial accounting subject in which we are trying to solve some problems. So let's see. So problem number 111. So Pratt company has old inventory on hand that cost 15,000. Scrap value is 20,000. Okay, so let me write down. Okay, so Pratt company old inventory equal to $15,000. Scrap value equal to $20,000. So here one concept you should understand. Old inventory as per the account books. Okay? So as per accounts books, it is $15,000. But then if you scrap the inventory, you give it to somebody outside. Some people scrap, they can purchase, and they are ready to offer $20,000 here. So that is the scrap value, $20,000. So right away you can simply dispose your old inventory and gain $5,000 here because you are losing 15 and gaining 20. So 5,000 is the profit unit. Anyway, so let's continue with the question. The inventory could be sold for $50,000 if manufactured further. Okay, so inventory with additional manufacturing. Then the selling price, okay, selling price will be $50,000. So simply you convert this 15,000 old inventory, you do some additional manufacturing, and you can now sell it for $50,000 instead of selling it as a scrap. This is even better, right? But then the problem is, if manufactured further, an additional cost of $15,000 should be this. So what is additional cost? Additional cost will be $15,000. Okay. So now, what will be the what should Pratt do? So sell the inventory for 20,000. So that is one option A, and then B option is dispose of inventory to avoid any further decline in value, and C hold the inventory, and D manufacture further and sell it for 50,000. So let us see what is the profit if we do that. Okay. So what will be the revenue that is earned? So your initial cost is 15,000. To that additional cost of more 15,000. In fact, I'm sorry, this initial cost should not be considered because you already have this 15 in your accounts as of this. Okay, so if you not consider that, just a minute, let me verify the answer. Okay, so we should consider because you are anyway consuming this inventory. So your costs are like this. These two, $15,000 for $15,000 for your inventory and 15,000 for your additional cost. But then what is your revenue you are getting? 50,000. So therefore net profit will be 50,000 minus this. So this 15 plus 15 is 30. So you'll get $20,000 dollar of net income. That is when if you do this option, that is additional manufacturing and selling. Otherwise, if I directly sell, my net income will be only $5,000. Okay, so directly sell, direct sell. Then 20,000 is your revenue minus 15,000. Then you will get only 5,000. So, uh, so instead of doing this, better to do this. So this is a simple question. So the answer is D. Okay, so that's what here marked. Next, let us go to the next question. Replacement of old machine with new one. Okay, so Salako. Okay, so let's do this question. The following information is being gathered. Okay, so I will not write down the same information once again on the book, but I will keep referring to this. So here, the question that we are now working on is 147 uh, Salako. Sorry. So, what is the net advantage or disadvantage of replacing the old machine? Okay, so let us try to solve this. Okay. Now, so you see, old machine, uh, it has a value. Okay? So value will be, so $3,000 was the original MRP, that is original cost. From that accumulated depreciation, if you remove 90,000, then the balance you have is 2210, like this. Okay? So this is the value of the old machine, the present value of the old machine. Okay. Next, remaining useful life. Actually, useful life is zero because 10 years is already passed. So operating cost is given. Right now, operating cost will not should not be considered. So the old machine is replaced. It can be sold for only 24,000. Okay? So uh, selling price of old machine is 24,000 only. Now, meanwhile, you purchase the new machine, right? So new machine you will be purchasing. Just a minute. 6,000 dollars. So new machine has become more costly. Now, but the thing is, you can actually accumulate the depreciation and calculate the cost. Okay? So I'll tell you how to do that. Just a minute. Uh, Actually, I was trying to refer to this answer. Finally, answer they are saying is 18,000, but then this formula is somewhat difficult. I am not able to understand. Let's pause. I mean, postpone this question. We'll come back to this question later. So, and we'll try to solve it. But I'll refer to the slides and then get a better understanding. So let's, postpone this question. So this question we'll do later. Let's continue making answering other questions. Yeah. So let's now go to the next one. Okay, so here we have this is from chapter 9, that is Graver Industries has budgeted the following. So this is about budgeting. Okay, so chapter 9, and the question is question 2. So I have just started writing like this. So budgeted the following: the finished goods units on hand. So this is the prediction of the sales: January 10,000, February like this. So So now we have to do the production budget. So here the question you can see for the first quarter of 2020, prepare the production budget and direct materials budget. So let us do production budget. Okay, so Craver Industries, production budget. So actually, for every budget, there will be for production budget, for sales budget, for materials budget. There will be a standard template. So it will be nice if you refer to that standard template to see. But anyway, so let us. But you can also solve it logically. See, in order to know how much to produce, you should start with how much is the expected sales. Okay, so expected sales. Okay, so for the month of January, February, March, because they are only asking for 3 months. Okay, what is the expected sales? January 10,000, February 8,000, March 9,000. Okay, so 10,000, 8,000, and 9,000. So these are the expected sales. Now, finished goods on hand on December 31 was 2000 units. Okay, so this is a finished goods, that is closing balance. So finished goods inventory on December 31. So therefore, on January 1st of 2020 also the same 2000 units will be uh, finished goods. Okay, so here you can write uh, beginning. Just a minute. Let me one see which comes first. Okay, I'll write desired ending inventory, finished goods inventory. I'm sorry. See what I'm doing in the second column. So this is the first row. Then the second row, desired ending finished good inventory, and then beginning finished good inventory. So at the beginning of January, what is the inventory? Okay, so you see here, at the end of the December, it was 2000. So at the beginning of the January first, also it will be 2000. So here I will write 2000 is the beginning inventory. What is the desired ending inventory? At the end of the January 31st, how much inventory you should have of your finished goods. That is mentioned here. Uh, this raw material is not required. Finished good inventory at the end of each month equal to 20% of next month anticipated sales. So this is the important statement. So finished goods inventory at the end of each month is equal to 20% of next month's anticipated sales. So what is it? Next month anticipated sale 8,000. 20% of 8,000 is 20% of 8,000 is 1,600. So here I need 1,600 of the finished good inventory. Ending inventory of finished goods should be 16. Similarly, next month is 9,000. So here 20% of 9,000. So that will be 1,800. Similarly, if you refer to the April, so what is the expected sales in April? 11,000. So at the end of the March, you should have 20% of 11,000. That is 2,200, like this. So this is 20% of this, 20% of this, and this is 20% of 11,000, which is for the month of April. Now, what is the beginning inventory? Now, what is the beginning inventory of February? The ending inventory of January will become the beginning inventory of the February, right? Because the same thing. Okay? So 1,600. Similarly, ending inventory of February, that means what you have on the February last day, the same you will have on the March first day. Okay? So like this, 1,800. Now that you have this, see, you have to sell this many. That means how many you require. Okay? So uh, production production required. So production, definitely you need this one, plus beginning inventory also. See, plus this one, that is ending inventory also you need to produce, but then you already have some beginning inventory, so you can minus this. So basically this will be plus, this will be plus, and this will be minus. So 10,000 plus 1,600 minus 2,000. Okay, so let me do that calculation here. So 10,000 plus 1,600 minus 2,000, 9,600. So this should be the production in the month of January. Okay. Next, what is in the month of February? How much production is needed? So you need to sell 8,000 units, so that you have to produce, and you need to maintain 1,800 balance. That also you have to produce. But then closing balance you already have, that is the beginning inventory you already have 1,600. So this plus this minus this. So 8,000 plus 1,800 minus 1,600. So 8,200 is the production required in the February month. What is the production required in the March month? Same, 9,000 plus 2,200 minus 1,800. So 9,400. So this is the production required in the month of uh, Jan, Feb, and March. So this completes the production budget. Okay, production budget looks like this. First line will be expected sales. From expected sales, you are calculating the expected required production. Okay, so like this. Let's verify our answers. Yes, the answers are matching. Now, one more thing now it is asking is direct materials budget. Okay, what is the direct materials budget? So, if for the given production, how much you will need? Okay, so let us do that here. So, what you do is direct materials budget. So, the first line of direct material budget will be last line of the production budget. Okay, what is the last line here? Production required. Okay, so Jan, Feb, March required production. So required production same 9,600. So here it is 8,200 and 9,400. Now let us read the this thing. Each unit requires 3 pounds of raw materials and average of $4 per pound. Okay? So each unit requires 3 pounds of raw material. Okay? So raw material required will be nothing but production into 3. Okay? So 9600 into 3. Okay, so let's do that. 9600 into 3, 28,800. Next one, 8200 into 3, 24,600. Then 9400 into 3, 28,200. Okay, so I got the, uh, just a minute. How come 9600 into 3? Sorry, this is 800. Okay, so now I got the raw materials required. Now this is in the pounds. Okay. Now what is the cost? Cost of raw material. So $4 per pound. Okay, so 4 into M. So whatever is there here multiply by 4, right? Because here it is given $4 per pound. But before that, I think we need to consider the uh, not now itself. So this line I'll remove. So first I will write the desired ending RM inventory. What is the desired ending inventory of the raw material? Okay. Then what is the beginning inventory? Desired beginning inventory. Beginning raw material inventory. Okay. So what is the ending and beginning inventory? Okay. So let's look at the logic. So here one point is given. There were 8640 pounds of raw material on hand at December 31. The same will be there on this January 1st, 2020. So 8640 is the beginning raw material. 8640 pounds is the beginning of raw material on January. Now, what is the ending raw material in January? That will be policy of maintaining raw material at the end of each month equal to 30% of the pounds needed for the following month's production. Okay, so this is the following month's production 26,400. What is the 30% of that we need to maintain at the end of January as the inventory? Okay, so 24,600, right? 30% of it. So 24,600 into zero point 0.3, 7380. Okay, so that 7380 should be maintained here, 30%. Now, similarly, 30% of this. What is 30% of 2820? 2820 into zero point 0.3. That will be, sorry, 28200 into zero point 0.3. 8640. Now I need to know what is the ending inventory of this. So for that I need to know what is the production in month of April. So that calculation needs to be done. So let us look at the thing. Let's see how these people have done it. So 10,620. Okay, just a minute. See, in April, total units required, how many? I think we need to calculate that also. Let's do that. They have directly given formula. See, in April, so let's go back to the production budget. 10,000, 11,000 is the expected sales. 20% is here. The same inventory has to be maintained here, 2200. So therefore, what is the desired finished good inventory? That is 20% of May's this thing. So the May is 15,000. Okay. So you take 15,000 and then make 20% of it. So it will be 3,000. So this is the 20% of 15,000. So now 11 plus 3, 14 minus 2,200. Okay. So how much it will be? So 11,000 plus 3,000 minus 2,200. So that will be 11,800 as the uh, production. So same 11,800 will come here. 11,800. This is for the month of April. Now, for that 11,800, what is the raw material? Raw material simply multiplied by 3. Okay, so 11,800 multiplied by 3, 35,400. 35,400 is your raw material for the month of April. Now, for the 35,400 raw material, 30% you need to maintain the inventory here. What is the 30% of that? Into zero point 0.3. So, we are getting 10,620. Okay, so that is how we are getting this amount. Now, what is the ending inventory? Beginning inventory of February. Ending inventory of January is nothing but the beginning inventory of February. So that will be 7380. Similarly, this will be 8640. So now the total material required. Okay, so this is raw material required will be 28,000 pound, 800 pound. This plus this minus this. So this will be plus, this will be plus minus. That means the raw material required for production, then ending inventory you have to add, and beginning inventory you have to subtract. Okay, so let us do that. 28,800 plus 7,380 minus 8,640. 27,540. Next, what is the this thing? So 24,600 plus 8,640 minus 7,380 will be 25,860. And finally, this one 28,200 plus 10,620 minus 8,640, 30,180. Now, this is the raw material required. What will be the cost of raw material? Cost of raw material. So, will be whatever raw material required pounds multiplied by 4. So, this is in pounds. So, this multiplied by 4 will give you the answer. So, already I have this number. So, into 4, I'll get 120,720. And this one, I can say 25,860 into 4. 103,440, and this one is 27,540 into 4. 110,160. So this is the final budget that is required. So this is called the direct materials budget. So you need to spend this much money, purchase this much of material, and do this much of production. Then you will meet the production requirement. Let's check the answers. I think there's a small here difference. This is supposed to be 680. No, this is 860 only. 7380 8460. This is 8460, and because of that, this will be 25680, and this will be slight different. Other than that, this also needs some small change, because here also it will be 8460. The same number will come here. So just if you once again cross check all the calculations, then it should be fine. So, but general procedure you came to know, so that is what matters. So let's stop this video here. Let's record one more video for the other problem.